Okay. Hi, everyone. Good morning. We're just a couple seconds away from the top of the hour, so we'll let our participants join and get started in just a few minutes. Welcome. Love seeing everyone roll in.
Isabel, I always refer to this as the popcorn effect, where everybody starts coming in, then as you know, you only get like one or two people coming in. That's when you know it's ready.
the last few kernels. Yeah. Awesome. It's 11 a.m. in Bozeman, Montana. So let's wait just one more minute before kicking off. And it's sunny. It's actually sunny, but Lisa, your background is nice and blue.
Mm-hmm. Well, this is what it looks like where I'm looking at right now. So it is kind of accurate.
All right, we're starting to see attendees slow down just a little bit, but we'll get those last couple of folks in, and I'm sure we'll have another few more join us. Get comfortable. We'll be here for the next hour together, so grab your coffee, your water, your tea, whatever gets you going throughout the day. And it's 11:01 where I am, so I'm going to go ahead and kick things off. Welcome. I am Isabel Leong. I am a lead member experience specialist here at XYPN, and I have the pleasure of having Lisa Asher on with us this morning. Lisa is the managing director of XYS, and she has a great presentation prepared for us. So we're excited to dive into the world of TAMPs and investments and pricing our services. But before we get into that, I just want to welcome all of you today. We've been hosting these member perspective calls for quite a few years now, and they've always been such a great opportunity for people who are, you know, kind of thinking about joining XYPN, sort of on the periphery of our community. It's a great opportunity to dive in and really get a feel for who we are and what we do, and get your questions answered. We know people who've attended these for months and months before they joined, or maybe they joined, watched just one and then they're like, yes, and they're all in. But we do host these every month. And I do want to make sure that you are aware, we do have one coming up in October as well. That'll be bookkeeping basics for financial advisors with our FAB Encounters manager, Dan Keslin, and FABC senior accountant, Haley Stewart. I'll have our marketing team drop a link to that in the chat. But for today, this is Lisa's chance to shine, and an opportunity for you to get to know what she does with the XY Investment Solutions team. And our topic is how to incorporate investment management in your fee-for-service financial planning practice. Lisa has a short presentation that she's prepared, but I also want to make sure that you know, we've got a number of great questions submitted before the webinar today, and also be sure that you can use the Q&A chat to drop any questions in there. Well, we'll get to them at the end. So go ahead and use that Q&A feature. And Lisa, why don't I turn it over to you? Go ahead and introduce yourself and take it away.
All right. Thank you so much, Isabel. Appreciate the introduction there. And again, welcome to all of you. This is also my first member perspective call. So I'm looking forward to sharing more about what we do with investment management, how you can incorporate that into your business, and hopefully help you build successful financial planning practices. So a little bit about my background. I just started as the managing director of XY Investment Solutions about a year ago, and I come from a background working in RIAs, working in the portfolio management department. So running their investment strategies as well as the implementation of all of that. So I've worked with a team of 15 advisors, helping them implement investment management. And now I'm working here, bringing that to the many advisors that have started out their own businesses. So trying to provide that same high quality and high touch service support of a portfolio management department for those who are starting their own businesses. I've also worked in the the fintech space. So helping advisors understand how to communicate about investment management, what's going on in the market. So a lot of background in supporting advisors. It's what I'm passionate about, not necessarily doing all of the investment management, but helping advisors see how this can be a successful part of their business. So I'm really excited to bring that to the XY team and to have the opportunity to work with all of you. So with that, we are going to, let's get right into this because we have a lot of material to cover. Again, I do appreciate all the questions that have come in ahead of time. I have addressed some of those in the presentation here, but as Isabel said, there's also the Q&A. We'll have some time to answer anything new that comes up. So without further ado, I want to get into today's agenda. First, at the top point, I want to talk about defining investment management. I think this is really important to just take a step back and say what it is we're actually trying to incorporate into our businesses, what we're trying to pitch to our clients, because as one of the questions that came in, there are a lot of misconceptions about investment management. So I think it's important for us to spend a lot of time talking about what it is. And this is also something that I work with all of our members on once they've joined the network on how to launch this. So this is one favorite topic of mine. Next, after that, we've determined what it is. Then we're going to talk about how you can communicate your value as an advisor. I also get a lot of questions about, well, if I'm not doing the investment management, or if I'm just using passive strategies, am I really adding value? And the short answer is yes. We'll definitely talk about some of the different points in the investment process where you have the opportunity to add value and communicate that to your clients. The last two topics we'll go through are pricing considerations. Again, that's also a big one, especially for XYPN members. Looking at the retainer model for financial planning. We'll talk about the differences between financial planning, investment management, how you can price investment management. There's short answer to that. There's no here's one specific way or here's the one best way. There are a number of different factors, and I think that go into your particular business. So we'll dissect some of those and give you some talking points, and then finally we'll talk about whether or not to outsource and talk a little bit more about XYS as a TAMP. So for those of you who aren't familiar, TAMP stands for Turnkey Asset Management Platform or Program, and this is the kind of mechanism by which you can outsource investment management and offer that to your clients. So we'll talk about some considerations there for you. And so that wraps up our agenda for today. The goal is to help you come away with being excited about offering investment management and learning how you can do that without it overtaking all of your business. So I do hope that we're able to make this time spent today very valuable to you, and that you're able to come away with at least one nugget of advice that you can incorporate into your own business plans as you venture out on that decision. So we'll get started with the defining investment management. So I do want to address a little bit of the evolution. So we do know that financial advisor, financial planner, wealth manager, a lot of those terms for clients, they don't really understand some of the differences. And a lot of that comes from, we think about the evolution of our industry of advice. We started out as stockbrokers. So we were selling very specific securities. It then evolved in the 90s to more of this holistic investment management. So we're starting to incorporate asset allocation. We're starting to communicate that to clients. And that's where the percentage of AUM fee really became popular and has been dominant in kind of a lot of clients' mind, has been dominating the types of clientele we're able to serve. And then as advisors, we're saying, okay, I need to differentiate myself. I need to add more. We start to see financial planning come into the picture. But then we also start to see financial planning becoming something, a service on its own, where we're not just throwing in financial planning in with investment management. We're really leading with financial planning and incorporating investment management. And I think this is really where, you know, we've evolved to the right point, because as you know, laid out here, the way we think about financial planning is that this is something, you're creating this roadmap. You're saying, here's my destination in the way of, here are the goals I want to achieve. Here's some of the ways that I can go about doing that. And investment management is a tool. It's a tool to get you there. It's one of the things that you can use. You can use insurance. You can use other strategies in terms of how you're saving, how you're budgeting, how you're managing debt. Investment management, you're looking at the assets that you're accumulating and how to keep them working for you so that you do get to that end destination. And that's where for advisors is figuring out where that kind of insertion point is. When in the financial planning process do you talk about, do you start to include investment management? And I think to answer that question, we go into, well, what is the actual investment management process? So we start off with, I'm sure a lot of you have seen, here's the whole investment management process. And this goes through all the different points where you as an advisor add value. And it also talks about how to put these different pieces together. I think a lot of the misconceptions with investment management, you know, talking to family members, talking to neighbors, is that it's all about stock picking. I have gotten the question so many times about, hey, what's a good stock? You're an investment manager. Tell me what a good stock is. And the answers I always give are frustrating, because I'll start with things like, well, what is your time horizon? And that's frustrating for people because they're like, just tell me the good stock, right? So that's where a lot of the misconceptions come into play. And then we start to think, well, you know, it's trendy to say investment management is commoditized. Anybody can go into a passive strategy. And we are just talking, when we say passive strategies, we are just talking about one small piece of this process. Your value as an advisor, what we're providing here is the entire process put together. And this tells us where we're going to include this in the financial plan. So I'm starting off with the financial objectives. Of course, it's very important to know where you're going, why you're going there. And the financial objectives, the things that are happening here that I've listed out, this is what's going to be included in your investor policy statement. So you know that in 40 years you want to retire. You know that in 20 years you want to be able to fund your children's college education. You know certain things, certain milestones financially that you want to hit. So our goal here is to say, well, okay, you want to retire in 40 years. Well, what does that mean in terms of a return? What types of returns do you need? What is your risk tolerance? What is your capacity for risk? And what are some of the constraints that we need to look at along the way? We want to map all of these factors out so that we have a clear plan for what strategy. This will tell us what securities we need to select, what our asset allocation is. And so this is really where I think you as an advisor in the financial planning process are providing a ton of value. This is the link to all the things that happen in investment management. If anything changes in that financial plan, we do need to revisit this investor policy statement, these financial objectives. We need to make sure, are these still valid? Are they still on track? Then once we have this plan in place, this is, you know, kind of like our blueprint, if you will, then we can start to get into, you know, the sexy part, if you will. So talking about, okay, what funds do we select? And what is our asset allocation? So this is where the majority of the return number really comes from, is that decision of 90% equity, 10% fixed income versus 40% equity, 60% fixed income. This is really going to be the biggest decision. And this is going to be based on, well, what are your return objectives and what is the risk tolerance and capacity that you're willing to accept? And a lot of times too, what we'll find is that there's sometimes a mismatch. Of course, everybody wants 11%, 12% returns, but very, very low risk. We know that that's not realistic. So part of what we're doing is coaching expectations. And I'll talk a little bit about that after we kind of go through the process here. So for the asset allocation part, this is where we are making our assessments about the economic, the long-term market cycles, our economic forecast, if you will. We are starting to create these models that are X% equity, X% fixed income. We're deciding which of the sub asset classes we want to include and in what proportions to achieve the diversification that we're looking for our clients. We're also doing the investment research. So this is going to be those individual securities that are in place of our large cap US equity holding in our asset allocation model. This is where you're getting into more of the, you may be doing stock picking, you may just be using mutual funds or ETFs. This is where a lot of people focus their attention on when they think about investment management. So once you do all of that, then of course, you have a plan, you have the strategy that you need, but what is all of that without implementation? And for advisors that I've worked with, a lot of this part happens in the background. So you have a team supporting you, doing all of the nitty gritty account opening with the custodian, filling out paperwork and handling NIGOs, and then doing all of the trading, all of the routine rebalancing. And so this is the part that, you know, is often seen in the background, where it can be very time consuming, because especially with trading and rebalancing, those are things you do have to set a schedule for, and you do have to do within certain time constraints. So it can be what I've seen with advisors that have done financial planning work and trading together. What they've often struggled with is, well, I need to do my financial plans, I can't get those ready, but I have to do my trading within these certain hours. And so there's kind of this push-pull between which one's a priority. And one of the things I've set up a long time ago was always separating out some of those functions, so you have somebody dedicated to the trading rebalancing during the proper hours. And then, of course, you've implemented your strategy. Now you have to monitor it. You have to report on the performance. Is it doing what you're expecting? This is another one where your clients will be focused on. We are focused on performance. Is this is this strategy doing better than what I could have done? Is this strategy doing better than what another advisor could do? And this is also an opportunity for us to look at behavior management, to set expectations. So we do need to do our performance reporting, our monitoring, though, to make sure that the strategy that we picked is actually doing what it's intended to do, and if we do need to make some adjustments to the financial objectives. So this is this is the process. Putting all of these pieces together and orchestrating this into this dance, if you will, managing all of this. This is what you are providing to your clients, and kind of going through all of that, I think is really important for clients to understand. It's not just about the stocks. It's about there's about so much more. There's a lot of time, a lot of work that goes into this. So we start there. And then, just checking to see if there's, Isabel, I don't know if there's can't quite see any of the questions, but yeah, just feel free to interrupt me if anything comes up that I should stop in the middle for. So the next part I want to talk about, we know what the investment management process is communicating your value as an advisor. I've received a lot of questions about, well, I'm just going to refer them out to a third party, or they can manage the investments on their own. I can't really add value because I'm really focused on the financial planning. And I do think this is one where you have a lot of value to add as an advisor. And this one chart here, I, excuse me, I really love, because I think this is a perfect visualization of all of the value you can add as an advisor. So what's going on here? What we're seeing, what this chart depicts is looking at a 25-year time horizon. Very basic, invested $1,000 into the S&P 500. We are ignoring transaction costs, but what we're saying is over this 25-year time horizon, on the green bar, this is the client who has stayed fully invested. So if we think about what can happen over 25 years, there can be a pandemic, there can be a great recession, there can be shorter kind of, market, market volatility. So many things that can happen over a 25-year time horizon. And it can be very, very jarring and difficult to stay the course this entire time when you're seeing headlines about what the stock market is doing. So what we see here is for somebody who stayed fully invested in all of that, their outcome is 5,000 and change. What we see in the blue chart and the blue bars is what the effects of exiting the market after a 2% market move or worse, and then staying out for a specified time period. Now, the time periods themselves, I don't think are as relevant. It's the fact that if you're out of the market for any given time, you are drastically altering your outcomes at the end. We can see the impact of staying out of the market for just 1 week. To me, this blue bar, this is a phone call from a panicked client who is saying, the pandemic scares me. I don't know what the stock market is going to do. Please just get my money out. I'd like to go back into the market when I feel it's comfortable. That's that impact right there. If you can have the conversation to your client, if you're spending an hour on the phone with them talking through what's going on in the market, why it's important to stay invested, then you just save them from losing 50% of their outcome. And to me, if you're charging 1% or however, that's a lot of value that you just provided to your client. I also, I look at this too, and I think about everybody's favorite topic, the election, and a lot of people who are going to be concerned about what's going to happen to their portfolio. These blue bars, those are all conversations that clients didn't have with their advisors. So I think that this is one tool that we can use to really drive home the importance of staying invested. And the way we stay invested is through behavior management. It's through having these valuable conversations. It's not by having a superior investment strategy to the advisor next door. These are all things that you can do by talking on the phone to your clients, by talking them through what's going on with the economy, what's going on with their portfolio, how this all ties back to their goals. So I really love this as a visualization of your value. And then the next part, of course, is, well, why do we get to this point, right? And this is another a study that I love to use in terms of expectations. So we get to this point because we know that our clients are coming to us with certain expectations. One of my favorite stories is a family friend, not of mine, but of my husband, the nice doctor who was bragging about, he went to one advisor who got him only 10%, and then he found another advisor that got him 20%. He was like, oh, this is so great. And I had a lot of questions, of course, about what was the risk of that, and so many different things. But the point being that he had very high expectations, and for him to work with an advisor who only got him 10%, though that advisor may have been doing everything correctly, there still wasn't the perception that it was successful. So I bring this up to also share how you add value. And the Natixis Global Survey of Individual Investors shows, and I purposely put this as 2019. I'll get to that in a little bit because I do want to do a little bit of Q&A of polling the audience here. But we saw that investors last year had return expectations of 11%. We know that financial professionals had a little bit more of a realistic expectation of 6.3. So the gap here, this is what we need to address as financial professionals at the beginning of the relationship and throughout the relationship, because if we're providing a 8% return, investors will say, well, that's much lower than I expected, and I need to go to another advisor, or I need to do this myself. So we do need to, so this does show how important it is to start addressing expectations on returns. Now, the part I did want to do a little bit of polling to see if we can do that. So this was 2019, 10.9%. The last survey in 2020 was done around April. I think we all know that with the pandemic, with market volatility, interesting time to be talking in the end of the 12-year bull market, interesting time to be talking to people about what their return expectations. So I did want to see if anybody, if you're familiar with the survey or not, if anybody has any thoughts as to what they think investors, individual investors said this time around. And if you want to just put that in the chat or in the chat, I'd love to see if you have any thoughts on what it was this time around. And I don't see any takers, which, okay, that's fine. But I did do this exercise with a smaller group, and it was interesting because a lot of people thought, well, of course it's going to be a lot lower. But it was surprising in that it was 10.9%. So investors were apparently unflappable. They still thought that returns would be 10.9% in the long term. For the financial professionals, they actually were a little bit more optimistic, and it was about 6.7%. So despite all of the volatility, we're still very optimistic about long-term expectations. So I think that part is positive. But of course, it still shows that there is a gap and that we have work to do as advisors. I think not sure if anything else came in here. Very low expectations, 10%. So yeah, good stuff here. And building upon that, because I do like to go over some of the additional areas. And again, I think that this is, I think Isabel has a link to this, but it is a really good report to kind of build yourself up and give you different nuggets to talk about with your clients. But I think this is, these blind spots, these again go to how you can coach behavior, how you can talk about the risks. Because last slide, we were focused very much on returns, but we also need to understand the risks of current markets, the risk of certain strategies that we're taking. Investors, they are very, very confident that they understand the risks. We as professionals don't think as much. So what are we doing about that? Those are things that we can think about. Focusing on short-term returns. Again, investors, majority of investors think no, they're not, but majority of financial professionals say, yeah, I think you are. So again, these are things that we can address. And just another way to drive this home. Here are some of the things that we as professionals think we should be working on. The one that stands out to me most is preventing clients from making emotional decisions. Again, it goes back to staying invested. How do we do that? We can't do that with a superior investment strategy. We have to do that through these conversations that we sometimes feel are can be very repetitive. And that was one thing that was very frustrating to me early on in my career, was that I told this client about diversification, the benefits of it, a year ago, 2 years ago. Why are they still asking? Well, I think that we there's some recency bias, but also we're constantly getting new information, and people are processing the new information they had with the old information. And so additional questions come up, and it's kind of going counter to what they feel is important. So we do need to have these constantly have these conversations. I will say, if you do feel like you're being repetitive with your client, that's good. That's a good thing. That's not necessarily a sign that you're doing things wrong. So just a little bit of advice if you're if you're concerned about that. So pausing for a little bit, we talk about what the investment management process is, and then we talk about here's how you can show your value. The next part, of course, is, well, with value comes price. How do I set the prices? We have a lot of discussion about, is it percentage of AUM? Is it flat fee? And of course, the decision is completely up to you as the advisor, thinking about the particular niche that you're working with. Is a certain fee structure going to be more appealing to them? Is it going to be more conducive to them staying with their investment strategy? These are all things to think about, but I want to make a couple of points, and the first one being that financial planning and investment management should definitely be considered as two separate services. Now, this doesn't necessarily mean that you have to charge two separate fees. You can absolutely bundle your financial planning and investment management fee into one flat fee, for instance. Advisors have been doing this for a long time in the form of percentage of AUM. They've said, well, I'm going to include financial planning as part of that investment management package. So for the advisor who may have been charging 1.5%, they would say 0.75% is actually for financial planning. So we have been bundling these two services together, but it's really important that we're intentional that these are two separate services and we should price accordingly. So if we're saying to ourselves, well, I believe that my financial planning services are $250 a month, and well, I just want to include investment management because I don't want to, I'm afraid to charge my clients too much. I'm afraid they'll go somewhere else. That's a challenge that I know a lot of us face as we're building businesses, and that's one where I would caution to understand the value of financial planning plus investment management. They're not interchangeable. They are complementary to each other, and they're definitely two services you can and should be pricing for. Talking about the percentage of AUM fee, again, that's a lot of the issues with that were that we only had percentage of AUM as a fee, and so that made it inaccessible to those folks that did not already have a large amount of assets for which they could charge clients and earn their value. I think about if you're working with somebody who has $5,000 in assets to manage, there's a lot that you can do for them in terms of financial planning. They may be just starting out, so you can help them working on paying off debt, working on building up their first their retirement funds. There's a lot that you can do from financial planning, but if they only have $5,000 and you're charging 1% of your AUM fee, obviously you're earning a lot more than $50 per year. You're providing a lot more value for that. So that's where just having percentage of AUM makes it not profitable to work for those clients. So we never provided services for those before. But now, separating out financial planning and investment management, we are able to access those clients that may be able to pay $200 a month, $300 a month, or percentage of income. and you still being able to provide a valuable and profitable service. So having the two, having just one is prohibitive to working with a larger group of clientele. But there's definitely not anything to be not to be ashamed of in terms of charging on assets, because again, I think about kind of skipping around here, but I'm thinking about if you're working with somebody who's $5,000 at the beginning of the relationship, you may be providing much more than $50 per year of service. But if you're working with that person and you are incentivized to provide them value year after year after year, they get to $1 million in 20 years, you are providing, some might say, well, you're not providing $10,000 of service per year, but over the course of time, you've probably balanced out. So there's a lot of, give and take with the percentage of AUM fee, where at some points you may be providing more service, more value than you're being paid. And sometimes you may, over the course, you may be a little bit less. So I think it's a hard one to average out our value over the course of the relationship. But I do think these are, of course, some of the inherent challenges in flat fee versus percentage of AUM fee. The other thing to consider is the all-in cost. We know so much about, all of the different hidden fees. If we've worked with a client coming over from another advisor, they never know how much they're actually paying until you kind of go through the statements and figure out, what the advisor was charging them, what commissions they were making. So it's really hard to kind of consider that all-in cost. So the things to consider here too, when you're saying, I'm going to charge a flat fee for AUM services, or I'm going to charge, 1%. I use 1% a lot because that's what we commonly see in the industry. It's not necessarily what you need to charge, but you use 1%. So we think about that 1%. There are also the expense ratios of the funds that are used in your strategies. There are also transaction costs if you're using mutual funds. Depending on the platform, how much they may cost each time you trade in that account. So these are all things to consider your all-in cost. And one of the additional links, I think Isabel may have provided this already, but Michael Kitces, of course, did a blog on analyzing the fees that advisors are charging for advisory services. And there is a lot of kind of, when you're breaking down by the account sizes, there are a lot of misconceptions about what the actual charge is. And we know that 1% is very common for a lot of advisory fees. That's certainly what we see in the 1 million plus. As those accounts get bigger, the median fee does come down. But for these lower account balances around the 250 range, we do start to see about 1.25%. So it's not, if you're thinking about benchmarks, charging 1.25% for an account that's $100,000 is not scary necessarily. It's very much in line with what we're seeing from other advisors. And of course, we do want to be conscious that we are still providing value. But of course, I do say, think about, if you're charging $100,000, if you have $100,000 account, you're charging 1%. Do you think you're providing $1,000 worth of service? I'd say, a year. I'd say absolutely. So couple ways to think about that. But then if you also add on, okay, well, the expense ratios that I'm using for my accounts, am I being cost effective there? And we do see a lot of variety. Of course, this depends on whether or not you're using a passive versus active strategy. Either or can be beneficial to your client. It's something that you need to discuss with them in terms of investment philosophy. But I personally remain agnostic about whether or not it's passive versus active. I'm definitely a fan of the investment strategy that somebody can stick to is the best one. So in addition to the expense ratios, we also have the transaction costs. Another another notch on the belt of the passive strategies, ETFs. A lot of those are no commissions now, so those have become much cheaper to implement. Mutual funds still tend to have ticket charges. There are of course funds out there that are no transaction fee, but those are some other things to consider. And I believe if you look in the report, you'll see that the median all-in cost is actually around 1.87%. So if you're thinking about how you're setting your initial advisory fee, also take into consideration what are the types of funds that you're going to use, how does the expense ratio come into play, and then what are the transaction charges. If I'm still in that 1.87% range, does that feel right to me? Does that feel right for my clients? And then I already talked about this a little bit more, but or a little bit before, but just the alignment of interests or the long-term incentives. One of the, you might be able to tell, I'm kind of pro percentage of AUM fee because I do think it aligns somebody to work with somebody over a longer period of time. I don't necessarily believe or take to the argument that it's an alignment of our interests. Like if you're doing better in the market, I'm doing better. I think that can also that can promote some riskier behavior. So if you're wanting to just grow your assets, you might be more inclined to put somebody in a riskier portfolio to grow their portfolio a little bit more. You might be, you might be inclined, I'm not saying nobody here would be, of course, but an advisor might be inclined to say, well, I want to put most of my clients in a 70-30, even though a 40-60 might be appropriate. So I think that there are some drawbacks to the alignment of our interest argument. I prefer to think of it as we want to be in a relationship over a longer period of time. I will work throughout that period to continuously earn and keep your trust. So I think that that's how I think about the how setting prices and how to think about the percentage of AUM fee. I'll pause. I saw a couple of notifications. I don't know if there is any questions that have come up yet, Isabel?
We do have a couple questions, but we can get to those after your presentation.
Okay. I also wanted to pause to take a drink of water. So the last part here, I want to talk about considerations for TAMPs. So a lot of you are thinking about starting your own financial planning practices. A lot of you may be thinking about, I want to lead with financial planning. This is what I'm great at. This is what I enjoy doing. I want to focus on. But I also recognize, since I assume you're here, that investment management is important to also include. But how do I include that without it taking over all of my time? And this is where you have a serious conversation about, do I work with a TAMP? Can I outsource all of this to still provide a holistic financial plan to my clients, but save myself some time, and also don't have to hire in-house? I think, again, this is akin to when I was working at an RIA, large RIA, we had a whole portfolio management department. TAMP is being able to provide this portfolio management department at scale to advisors that maybe just starting out, maybe solo advisors, or just simply want to outsource investment management so they don't have to manage the in-house talent. So with that, what are some of the considerations that we need to think about for choosing the right TAMP for you? And we also do have a blog about this as well too, where we go into a lot of the detail, but here, talking about first investment philosophy. Touched upon this briefly, passive versus active. I think that's one of the main decisions that advisors need to make. And it's one too where you can be agnostic, and it can be one where you offer both. If you have clients that are very much low cost focused, they're comfortable with market returns, you may focus on a passive strategy. If you're thinking about clients that are just starting out, have smaller balances, I think that passive strategies can be more valuable to use there, and then working up to an active strategy as those accounts grow in size, because one thing with active strategies, you also have to overcome the higher expense ratios. So these are things that you'll talk about with your clients, and you'll want to see, does the TAMP that you're working with, are they just passive? Are they just active? Are they also tactical? Are they going to do anything that's more shorter term in nature to try to outperform? These are ones that you want to make sure that you are aligned with, because of course you will also be on the hook. You will be on the front line for discussing this philosophy with your clients. In a similar vein to the investment options, it's not necessarily just the passive versus active strategies. It is the ability to do separately managed accounts. It's the ability to incorporate individual stocks. It's the being a little bit more customized in your approach, being able to use somewhat more sophisticated instruments like options for risk management. These are all some things that you'd like to consider, and these again go to your niche. So if you know that for some of your clients, perhaps they have concentrated equity positions, and you know that you want to use hedging strategies to manage that risk, that may be something you want to talk to your TAMP about, because you know you'll be doing that over and over again. So understanding what the options available to you are important, not just in your current state, but as you grow as a firm. And then the third one we talk about is custodians. That's another layer that you're going to be working with in the TAMP, unless they self-custody. So you won't be just having a relationship with your TAMP. You'll also have that relationship with the custodian, and understanding what their role is, how you're going to interact with them, understanding things like when there's a merger, such as between TD and Schwab. How will that impact you, your clients, and the TAMPs that you're working with? Of course, there's, as with TD and Schwab, and happy to answer any questions about that. There's certainly a lot of uncertainty in terms of we don't know in 2 years. There may be a Fidelity, a Schwab merger, or whatever. We certainly don't know all of those things, but we can talk through, figure out solutions to minimize disruption to clients. So those are all things that you want to know that your TAMP can talk to you about and can help you solve for, which goes into the support levels. Of course, you want to know that if you are working with a TAMP, are they going to be supporting you if you have a tough conversation with a client? Are they going to be able to help you with any specialized trading strategies? These are all depending on your experience level and your willingness to roll your sleeves up with investment management. You want to understand what the TAMP is going to be able to do to support you. One of the things that I'm a very big proponent of is this coaching aspect. So talking to advisors that they have clients that are just, they want them to customize a portfolio. They don't necessarily know why, but they don't want to lose this client. So how do we provide a solution for them? I'm a big proponent of not necessarily just giving the client what they want, but talking through what's driving their motivations, and are there alternative solutions that we can look at. So that's one where I'm a big proponent of coaching advisors, not just providing here's the blueprint for working with us and we take care of the rest. So working hand in hand, and then of course pricing. Everything, pricing should always be a consideration when we're looking at providing or including a service provider in our mix. It's there is a wide range of pricing, as well as how people are priced, how TAMPs are pricing. You do have some flat fee per account options. You also have the percentage of AUM, similar to what you might be charging to your clients. So looking at if you're saying to yourself, well, I'm going to be charging 1%. Working with a TAMP that's 35 basis points, that's 30 basis points, 20 basis points. What does that look like for me? What am I getting for the value, or what value am I getting for the price that I'm paying? These are all things that, I wouldn't say necessarily just you're not solely driven by one consideration, but considering that in the context of, is this the right investment philosophy? Is this the right investment options, custodians? Is this the right support? So with that, I will take a break and stop talking at you, and hopefully take some questions here and have a little bit of a discussion. I do want to thank you all for the time that you spent here today. I do hope that this was really helpful, and I do unapologetically end with my my coworker here, since we've been in this together for the last 6 months. So this is Belle, our Chief Risk Officer.
Thanks, Lisa, and thanks, Belle. Super cute picture. Great presentation. I feel like every time I listen to you talk, I learn a little bit more, about the world of investments. Although I don't come from that background, you do break it down and make it really easy to understand. And we've been getting some great questions in the Q&A. Go ahead and drop your questions in there, and we'll try to get to as many as we can in the next few minutes. We had a good one from Dan about pricing, of course. I know that's a really hot topic, but he asked, do you charge in arrears and monthly or quarterly? Also, do you draw outside of the portfolio or from the portfolio?
Yeah, so if this is a question in reference to XYS, the answer is all of the above. So our approach is that we match what advisors want to charge and how they want to charge. So we have advisors that do charge monthly. We have advisors that charge quarterly, and also in arrears and in advance. Those can be pulled from the actual client accounts, but we also have some advisors that want to be billed directly. So it's really, we are agnostic in terms of the pricing preference. It's really up to the advisor to tell us what's best for them.
So there's a whole range of ways people can do this. What's the best way for them to get advice on what works best for them and their clients?
Well, I think these are where the one-on-one conversations, I think, are really helpful. As with any type of investment recommendation advice, it's always, well, tell me a little bit more about the clients that you're working with. Tell me more about your business model. Tell me more about all of these specifics that can say, okay, maybe you do want to charge in advance or in arrears. And if you do, here are some additional considerations. So I think it always comes down to having those one-on-one conversations about what's going on with you.
Great advice. I liked this question that was submitted before in preparation for this webinar. Do I need to offer investment management? Can I be a successful financial advisor without offering investment management?
Well, I mean, we know where I'm going with this, of course. I mean, there are models where advisors do kind of outsource investment management. So the caveat that I have there is I would ask, what is the hesitation regarding offering investment management? Is it a belief that is a belief that it's commoditized, that it's not really adding that much value, it's going to be too much work working with a TAMP? These are questions that we can certainly talk through. If you think that it's going to be a little bit too much work with the TAMP, if you don't feel that there's enough value there, I do hope that we went through some talking points today to kind of allay some of those concerns. But then again, without knowing specifically what's driving I don't want to do, or I don't know that I need to do investment management, So I would start with that. I do think there is definitely a lot of value to providing financial planning, investment management together. I do believe that they go together. One isn't replaceable for the other. And some of the conversations I can speak to with for that I've had with advisors are they express the frustration of, well, I outsource investment management, but I tell them to do something and then they don't do it. And then they don't give me the information. And it's just easier if I kind of have it all together. So that is one, if I could talk to one specific pain point that some advisors have that don't do investment management, that of course is, that's a small sample. It's a handful of advisors. I'm sure that there are some advisors that do it successfully, but if there is a hesitation about, well, I just don't want to do it. I don't want to do it for these reasons. I'd love to have that conversation.
Awesome. Thank you, Lisa. I had a good question about, does XYS provide client-ready versions of charts and resources and educational materials?
Mhm. Yes, we do provide, we have a quarterly market commentary. This is something that that can be white labeled to your firm. So we provide you, we actually put together the packet for you. So that's just one example. We are working on some additional market commentary and chart pieces that advisors can use, but certainly something where we're very, if an advisor requests something, we certainly look into different ways to provide client-ready materials.
All right. We had a couple questions about the upcoming TD Ameritrade and Schwab merger, which I'm sure that you have answered and answered again. But can you talk a little bit about what that might look like over the next couple of months and years, and specifically, with XYPN advisors?
Yeah, and it's very timely because I'm having a conversation with our relationship manager at TD right after this call. So I'll definitely have a lot more new information then. But what I know right now is that, so TD and Schwab, where they currently are in the process is expectations were for the deal to close the end of this year. And so that seems to be moving along, and they're starting to prep for beginning integrations with Schwab. Now, we know that from the TD Link conference earlier this year that one of the biggest pain points that advisors were worried about was repapering accounts. So if we go from TD to Schwab, we have to do all new paperwork for our clients. That was apparently put down. So we will not need to do any new paperwork. Now, that is, of course, what they said back then. We need to see if that really does happen. Another concern that's been coming up is advisors with XY do not have minimums, asset minimums, and that was something where advisors who were kicked off of Schwab came to TD, and then they're worried that, well, I still don't have the minimum asset requirements, so am I going to be kicked off of Schwab? That is also something that we've gotten a verbal agreement. This is back in October, November of last year, but we did get a verbal agreement that Schwab is not kicking off advisors. To further qualify that, TD, the XY advisors make up about 10% of TD's current advisor platform. We are confident that Schwab won't purchase TD just to kick off 10% of their advisors. So just to provide a little bit of context, we do feel good about that. The latest I guess tech platform thing that I know about is in regards to some of the tools. So there is some question about whether VEO1 will continue under the TD Schwab brand. They are confident that ThinkPipes iRebel will continue to be utilized by Schwab. They don't really have like an iRebel component, so they do think that will be carried over. And then in terms of timeline, we still expect this full integration to take place in over the course of 2 to 3 years. So for advisors that are saying, well, I don't want to onboard to TD because I'll just have to onboard to Schwab, that could very well still take 3 years. So you might be sitting on the sidelines, still trying to figure out what to do while we sort that out. 2 or 3 years, a lot more could happen. So being able to kind of make the best decision you can with the information you have now is really the best course of action. And our plan here is we're here to make sure that if you do have a transition to another custodian, we make it as painless as possible. So I think that's, again, too, one of the benefits of kind of working with a TAMP versus going on your own, is that, you have this kind of, this partner to the custodial changes. So.
Awesome. Thanks. I think we'll probably have time for one more question, but before we get to that, I do want to ask for everyone's feedback about today's webinar. We would love for you to share your thoughts. Was this helpful? Would you like to hear more about what subject? So go ahead and grab that link in the chat and fill out the survey. And of course, join us next month. We're going to be talking to a couple of our bean counters, Dan and Haley, who are on the FA Bean Counters team, about bookkeeping basics. But thanks everyone so much for joining today. It's been great. I always enjoy talking with Lisa. I know that she's going to be doing a coach's corner at XYPN Live-ish. So if you want to hear more from her, definitely grab your ticket. But Lisa, perhaps one last quick question, and I know this is a really robust one. What compliance issues come with investment management?
Well, I mean, the the compliance issues that come with are just the maintenance, really. So you do have to make sure that you are reporting things like trading errors on a regular basis, that you're keeping a chief compliance officer log of all the goings on. You're filing your 13F reports if you're large enough. So there's certain and you're updating your ADV. So it's a lot of compliance maintenance that goes along with investment management, similar to what you would be doing normally.
Awesome. Thank you so much. And I know that regarding investment management, you and your team make it as easy and smooth as possible, and you're a wealth of knowledge and resources. Similarly, we have a compliance team who does the same thing. So wherever you're at, whatever your expertise is, we've got you covered from XYPN. Thank you all so much for joining us. Lisa, your time and expertise is very much appreciated. Folks, let us know how we did in the survey, and enjoy the rest of your Wednesday.
Thank you, everyone. Have a great day.
Thanks.